from the US markets has not been all that great. In fact, the Nasdaq has seen its worst day since 2022. The domestic economy linked stocks, though, have gained. US futures have seen a bit of a rise ever since that sell-off overnight. But yeah, the jobless claims, they have fallen more than that was expected. WTI has gained 2%. And precious metals continue to see an uptick. So a bit of a shake-off, at least for US equities overnight.
Yeah, you would actually say that it's getting US markets are getting election ready, and given what we've seen in the US markets, especially after that big assassination attempt on Donald Trump, markets are factoring in a Republican victory. Now, a Republican victory typically means that it is good for old economy related stocks. It may not be great for the new economy stocks. So Nasdaq is down, S&P is flat. Dow is flat, but technology stocks have reversed. That's the global positioning for you. That's one. Second, post the Fed commentary, and now that the fine print of the beige book is out, it appears that inflation, which has been the biggest concern for the US market, that's coming under check. So you are starting with mixed set of global cues. You are starting with cues which in a sense are more going to be local dominant. Local cues will have a much greater impact. The local cues are centered around flows, budget and earnings. So next couple of days, I think budget expectations, budget trades would be supreme. Then you have earnings where individual reaction would be there, and then you got flows, which appears that as of now the flows into emerging markets from FIs and the domestic flows from DIs, that will continue. So there's nothing wrong with the setup per se, but it suffice to say that benchmark indices are looking either tardy or they're looking slightly rusty.
And investors continue to, favor, at least for US equity markets, some of those rate sensitives amid optimism on a possible rate cut following what Jerome Powell's commentary was, the fact that he continues to maintain caution on keeping rates higher for longer. That said, there are fears in the markets right now that perhaps there could be more stringent export restrictions from the US, and that's why you had some of those tech-heavy names actually fall off. But Avan, what about India markets?
Well, we're on a winning streak for sure. Third straight day that we've hit those record highs, so no complaints whatsoever. Of course, yesterday the markets were closed on account of Muharram, but nonetheless, on Tuesday, it was 24,600 that the markets hit. The broader markets also in fine fettle, and it was actually FMCG that was at the forefront. Remember, we saw that election day fervor, and then it was a bit subdued, but the FMCG index is now up for the 8th straight day on the trot. Of course, we'll be eyeing out the weekly option expiry, but the broader markets continue to remain near record highs. And for now, Nikunj, it seems like bulls firmly in control as we're running up to the budget as well.
So, Avan, it's just going to get more and more stock specific, and it is not that the market in a sense are exhibiting, extreme momentum. There's nothing wrong with it. I think markets are in a pause mode. Look at Nifty in last 1 week. I think it clearly is showing signs of consolidation, which I think are visible. Let's look at it. Superimpose that with the Bank Nifty. Last 7 days, what have we done? With all the rara feeling, the Bank Nifty is flat and the Nifty is also flat. So benchmark indices, despite the fact that FIs are buying, DIs are not selling, they're hugging on to the flat line. And that really may be the course for next couple of days. B, the breadth this week is showing evidence of not caving in, but it is showing signs of getting tired. So I think the word which in a sense describes the character of this market is that the bulls are getting slightly tardy. They are not going to be retreating. It could be a pause. It could be profit booking, some here and there. At these levels, I mean, it's very clear that it's hard to make a case for anybody to make fresh commitments, but the market can remain extended for an extended period of time. So there is no point in trying to prejudge that this is the end of this is the finishing line, which is that you should not sell. Like I was mentioning on Monday and Tuesday, sometimes just inactivity is also an action, which is you should not take large bets on the long side, don't create short bets on the short side, and don't be in a hurry to sell. So doing nothing also is also a strategy, and I think that is the best way. Where I think markets are disappointed is that you've not seen too much of action in banks, and I think that is becoming more like a problem area now. Every time the attempt by the bulls have been, I mean, bulls are basing the market excitement on the fact that banks are underperforming, they will come back. But you say you get 4 days of sunshine and then it's back to gloomy days. So that is a problem, I guess, with banks.
Seems like the Mumbai weather. But, that's exactly the commentary that we've heard from some of the big market participants, the likes of Vijay Kedia, etc., that they're not putting fresh money to work at these levels for sure.
You should not, investing in market. So there are two ways. If you're looking at momentum, and there's nothing wrong in it, I think momentum also seems to be peaking out. Look at some of the classics here. Let's say you look at some of the high flyers, defense names, or a name like Zomato. These are the high flyers. They're showing signs of pause. Nifty itself is hugging onto a flat line, and the bank Nifty is not done anywhere. So I think the markets are getting ready for pause, but not a retreat. B, for individual investors, and I'm talking about like investing here, they would look at margin of safety or they would look at valuations. And right now there is a complete disregard of what really could be called as cheap and good and value in the market. But the earning is so strong and the temptation of flows are so strong that whenever markets will fall, you will not see too much of downside. So the best strategy in this market is that if you're invested, stay invested. Don't commit fresh inflows. Wait for a bad day. You may get it in and around budget. You may get it in and around some global event, and that's the time to buy. But for me, the monitorable now would be that how US markets in the run up to the US elections they move. Because up until now we've not talked about it, but now that suddenly will start getting center stage. Yeah. I mean, global cues are right on the back burner. What is the first thing we discussed in the morning? We never discuss global cues because everybody's taking them for granted.
That's because it's local money which has led us to these levels where we are.
I think that will
FI
start
participation still is not back with a vengeance.
Yeah, so like we started the show today with global cues, I think we are increasingly going to be in that frame where global cues will start having an impact on the local markets now.
Yeah, absolutely. That's what's gotten us to where we are right now. And cues to watch out for. There's lots of earnings that are in the spotlight, heavyweights that have come out with their quarterly numbers and that are set to declare their earnings. So, for instance, Asian Paints, and all in all, yes, there has been glimpses of rural recovery, but the quarterly numbers have been rather weak. There's been muted demand that has hit volume growth, and the volume number as well as the margin number came a little bit below what the street was expecting. Meantime, you also had LTI Mindtree that came out with its quarterly performance. It was in line. Brokerages as well are talking about how EBIT is going to get cut from 15.9 to 15.4%, which is a little bit of a dampener. And then today, all eyes on Infosys. We're expecting the quarterly performance, and cross-currency revenue growth is seen 2.2% sequentially. So that's summing up some of the big earnings this week, Nikunj.
Yeah, I mean, you've heard from TCS, which was frankly better than what markets expected. Can Infosys deliver? And predicting Infosys numbers is extremely difficult. I mean, history has taught us that in between a quarter, a lot has changed for IT. What I would like to watch from Infosys is that are we at that turn, which is that has the contraction for IT, like we saw in TCS numbers, has that started? I mean, is that over, and has expansion started? And can they give you a convincing reassurance that the second half will be better than the first half? You already know the flavor of what they are committing to full year, and that's not a very impressive number. But post TCS, can Infosys really, you already have HCL Tech, so can Infosys really give a superior commentary and a superior outlook? That may have an impact of 2 to 4% on the stock. That's about it. But if markets get evidence that first it was TCS, now decently better guidance from HCL Tech and positive commentary from Infosys, then you have a trend in making. So I think if you have a trend in making, then IT, which has been on a avoid list, becomes a sector which you want to start revisiting. I continue to maintain a view that I'm not so sure where IT is headed. I think I'll wait for one more quarter to make a firm view there. But if we get evidence and early evidence that things are looking up, then IT will have potential to start outperforming in the second quarter. But you'll wait for Infosys numbers, because you at least need 3 out of 4 companies to align in the same direction before you can convincingly say that things are getting better.
Yeah, absolutely. And then, of course, for us, given that the budget is just coming up on Tuesday, The budget narrative has already begun, and we broke a story where sources are telling us that no major changes could be expected in the capex target in the budget, and that they may continue with the current capex target for the interim budget and maybe just about minor tweaks here and there based on the ministry's demand. That may disappoint the market, right? Because capex is that one theme that the market has bet on, and a continuation of the same is something that the market is expecting.
Yeah, so what you want to see is that, see, Aisha, what's the debate right now? The debate right now is that the government is aware of the fact that there is a slowdown in the rural end of the market, and the economy, in a sense, post-COVID has got divided, which means you need to revisit what really could be called as addressing the issue of rural stress. Now, when you have a kitty, you allocate, and that's what government has done. They've kick-started the economy post-COVID by increasing the capital expenditure, which in a sense had a greater multiplier effect. But because of poor monsoon, what's happened to the economy post-COVID, you do have an issue when it comes to the consumption cycle. And post this election, there is a clear indication that there is a section which you really need to now take care of. So could there be a compulsion and the necessity of the economy which could force government to reallocate money to, let's say, welfare schemes, focus on rural rather than infrastructure? That is a debate. Now, what we learned, and this is very important, we learned that government is likely to maintain fiscal deficit. They are unlikely to reduce their commitment towards capital expenditure, which is that the kitty, which is about 3.5 to 4% of the total GDP, that is unlikely to come down. And the focus would also be on rural India, which means the bias and the commitment towards expenditure and push towards infrastructure, be it road, railway, port, highways, that is likely to continue. And that in a sense means that there is going to be continuity, and the underlying tailwind which this sector is enjoying largely because of government push, I think that will continue. So no change in capital expenditure, and if the capital expenditure number moves in line with GDP, because GDP has gone higher, so the capital expenditure number will also go higher in terms of the absolute kitty, it clearly means that the government is committed to support the economy via infra, via road, via airport, and via ports.
Okay, fair enough. But let's.
If you like this video, then like, share and subscribe to ET Now.